Monday futures market outlook for January 4th, 2011. This is Patrick Sresna. For those of you that have not had the opportunity to try out eminisource.com's trading room, 5-day complimentary memberships are available. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. Does a very good job to depict the bull and bear market cycles the market has gone through. Back in 2009, it bullishly crossed above that 80-week moving average. We were then looking for a market consolidation, which occurred in the summer of 2010, and subsequently we've then seen the end of year rally. We're now going into and continue to go into a relatively bullish period within the market going into the first quarter of the year. We are anticipating there to be short-term profit-taking cycles, but anticipate that we should continue to see strength going into the second quarter of the year. When we take a closer look at that S&P 500 using the E-mini futures contracts, we saw this little triangle formation developing along this in November, drawn on the blue lines there. Essentially, when we had the bullish break higher, we measured out a number of moves that were targeting moves all the way up to this 1260 to 1300 level. We're now approaching those profit-taking zones. So really at this stage, the benefit of actually going long the market is very marginal to actually no benefit at all, as even though there might be a short-term follow-through on the upside, at some juncture there will be a natural profit-taking cycle in the regular ebb and flow of the marketplace. So at this juncture, we would suggest that anyone that's long this market may use this opportunity as to lighten up on their positions and be prepared to take advantage of market pullbacks to re-enter the market. Just to review our key points, we are intermediate bullish on this market and anticipate there to be several months more bullishness beyond short-term profit taking. There continues to be momentum loss and a lack of market breadth in this market, and literally this entire rally is riding on the backs of large cap stocks like Exxon Mobil, and really there's been periods in the past where we've seen these this momentum loss or lack of market breadth, and the market has diverged for many months in some cases before reversing. So we don't necessarily want to have that as an indication of a market top, but it's certainly worth observing that it's occurring. We are concerned about a profit-taking cycle going on through the earnings season, which is going to be in the first few weeks of January. At least the start of it will be. So really the next few weeks we'll be watching to see where and how a market pullback can develop. But beyond that multi-week profit-taking cycle, this rally can last deep into the second quarter of the year, and so we're just going to be watching to see where and how any profit-taking cycle may emerge to being a buying opportunity. Next here I want to take a look at the NASDAQ 100, and this is almost a spitting image of the S&P chart. We more or less had a bullish breakout higher. A number of our measured moves are targeting areas in this 2250 to 2320 area, so there is still a room for even 50-60 NASDAQ points higher, as it may finish moves up into the upside there. But overall, we from a technical perspective, we're looking to take some profits up in these zones. Next here I want to take a look at the US dollar index futures. More or less going into the Christmas holidays, we were looking at the potential of a dollar index that could break out above the 81-81.50 area marked off by the blue box. There was no follow through, and basically last week the dollar index had a very strong reversal heading right down to the 79 level, where all the lows occurred in December. Really at this stage we're at a make it or break it moment. If the dollar index reverses and starts breaking down, particularly driven by a euro rally, that would spur on about a selling that initially may test 78 but could go even deep as 76 for a retest of those previous lows. So it'll be critical for the bulls, the US dollar bulls, to hold this support line here. Otherwise the floor could really open up underneath for another leg lower. Next year, I want to take a look at the gold futures contract. Essentially here, we have a very strong reversal on the downside on Tuesday, coming off of a key top retest along that 1410 to 1430 area, where now it appears almost like a triple top style formation. It is absolutely critical that for the bulls on gold to reverse the sell-off that occurred yesterday. If we see good support lines holding in there and reversing, we have, let's say, a rally back above 1400 tomorrow, it may neutralize the reversal. But if we have any follow through selling, particularly below the 1360 1370 area on the downside, that would open the window for a retest of the lows around the 1320 area on the downside, but could easily see even 1280 or lower on the downside of a deeper retracement. Next year, I want to take a look at the E-mini crude oil contracts. We more or less had a rally over the last couple of weeks right up into the 91-92 focal point. We were actually targeting even a measured move that potentially could have gone as high as the 94-96 area. But with Tuesday's reversal candle on the downside, really at this stage, it looks like that 92 is going to be that overhead resistance. Again, one day doesn't make a sell-off, so if the bulls can dig in and reverse yesterday's damage, then there's still a chance that crude can make a push up to those highs. But if there's any follow through selling that really gets under the 87-88 zone on the downside, that would really open that window for a deeper pullback, even down to the 84-85 zone on the downside. Finally, I want to take a look at the 10-year Treasury notes. Very dramatic sell-off that we had in November going into December, but we really spent a better part of December just consolidating sideways in this little sort of flagging or triangle style formation. I marked off the 121 area in the blue box where the two swing highs occurred on the hourly charts, but there's room for this, if this is a flagging formation, to come and test all the way to the 121.5 to 122 area on the upside, or a much deeper retracement could go up to 123. We're not anticipating that, but nonetheless, eventually when this flagging formation develops, and even if it ends up being a triangle, we will be looking for the next shorting opportunity. We anticipate that the Treasury notes will have to go back and do some solid retesting at lower levels, and so we'll be watching how that develops going forward. That was your Monday Futures Market Outlook. Thank you for joining me.